Happy Tuesday, folks. Welcome to Liberty Call. I am Raymond Dahlman, your humble host. It is Tuesday, February 20th, 2024. Hope everybody had a good weekend. It was President's Day yesterday, and unfortunately, markets were closed, so I wasn't working, and had a colonoscopy. That was a whole lot of fun. And I busted my head open on, what day was that? Sunday? Saturday? Saturday, yeah. Trying to get a countertop off my brake front in the dining room and smacking it and missed the lip of the thing. Bunk! Hit myself right in the head. Didn't need stitches and it just had a little bump, but bled like crazy. Whew. Anyway, so $150 at the hospital for them to tell me, yeah, you don't need stitches, but we'll clean it for you. So thank you. Anyways, all right. Well, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. Unfortunately, the markets weren't real happy today, but you could do me something, help me out. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All righty, well, let's go ahead and get into today's numbers and see how things turned out. Dow Jones was down 0.17%, 63 points, closed at 38,564. S&P 500 down 0.56%, closed at 49.77. NASDAQ down 0.92%, closed at 15,630. The VIX was up 4.21% today. It's at 1533. Canada down 0.18. Brazil up 0.51, and Mexico down 0.58%. In Europe, Germany was down 0.14%, the UK down 0.12%, France up 0.34%, Netherlands down 0.88%, Spain up 0.94%, Italy up 0.08%, Switzerland up 0.51%, and Portugal down 0.32%. In Russia, both exchanges were in the red today. The MOEX down 1.14% and the RTSI down 1.03%. And the Asian markets looks like they were all open after the, I believe, the New Year. The Nikkei in Japan was down 0.1%, Australia down 0.08%, New Zealand down 0.87%. In China, the Shanghai was up 0.42%, the Shenzhen Component up 0.04%, China 50 up 0.03%, DJ Shanghai up 1/3, Hang Seng up 0.57%, and the Taiwan weighted up 0.63% for the day. Exciting stuff, I know, huh? Anyways, all righty. Well, let's go ahead and, like I said, the markets weren't in the best mood, but, it's kind of not to be surprised. Everyone was hoping that the Fed was going to just start dropping rates. That hasn't happened. They've kind of telegraphed that's not happening really in the near future. So, at the earliest, I would say June, July-ish. But that's my best guess right now. So we shall see. Now, again, the economy could hit go into the crapper in the next 60 days and then, everything changes. So we'll see. All right, let's get to this week's weekly economic update. Stocks fell last week as investors reacted to disappointing inflation updates and other economic reports that fell short of estimates. Markets were quiet Monday, but opened lower Tuesday in response to the January inflation report that showed higher than expected consumer prices. But stocks regained some momentum on Wednesday and rallied Thursday, despite disappointing results on both retail sales and industrial production for January. News of higher than expected wholesale prices on Friday put investors back on edge and kept stocks from ending the week on a positive note. The weekly loss broke a 5-week winning streak. All right, inflation perspective. The consumer price index data was one of the big pieces of news driving markets last week, with January's numbers coming in at 3.1% compared to a year ago, cooler than December's 3.4% year-over-year gain, but warmer than the 2.9% consensus. Jittery investors focused on the hotter than expected part. With the consumer report closely followed by disappointing inflation news on the producer level, attention quickly shifted to the Fed and what's next for interest rates. While the Fed indicated short-term rates may trend lower in 2024, the January inflation reports support Fed Chair Powell's recent comments that the Fed is in no hurry to cut rates. Economic data coming out this week. Tuesday, we have the leading indicators. Wednesday, the FOMC meeting minutes. So we'll go through that probably on Thursday. I usually don't do it day of. And then Thursday, we have jobless claims, existing home sales, and the U.S. Fed balance sheet. Companies reporting earnings this week. Tuesday, we have today is Walmart, Home Depot, and Palo Alto Networks. I saw an article that Home Depot was did not have good numbers, probably, and the excuse they gave was that it was a reduced home buying and construction. On Wednesday, we have Nvidia. Thursday, we have Intuit and Booking Holdings. And Friday, we have Berkshire Hathaway. All right. So good stuff out there. We usually cover the weekly update on Monday, but it was a holiday. I mean, things were open. I went to the grocery store after my doctor's appointment and everything else. I didn't drive. My wife drove me everywhere. She had the day off too. So you're not supposed to drive after you have anesthetic, especially fentanyl. That stuff puts you out like that. I mean, I'm sitting there talking to the lady and then cook. Next thing I know, I open my eyes and I'm in the recovery room. So, all right. Let's get to the market recap. U.S. stocks slip as Nvidia drags tech lower. Walmart jumps on earnings beat. All right. U.S. stocks experienced a downturn on Tuesday with investor sentiment turning cautious ahead of quarterly reports from Nvidia and the release of the Federal Reserve's January meeting minutes later in the week. Nvidia's more than 5% decline weighed heavily on the tech sector, sparking concerns among investors awaiting the chip maker's earnings. Analysts anticipate Nvidia not only surpassing quarterly estimates, but also providing optimistic guidance amid rising demand for AI-driven chips. Intel, however, managed to evade the broader chip stock decline following reports of potential subsidies from the Biden administration. Yeah, because the taxpayer should really be helping out a private company. Market attention also turned to the Federal Reserve's forthcoming minutes with expectations of insights into the central bank stance. Markets currently anticipate 4 quarter-point rate cuts this year, beginning in June, in response to recent consumer and producer price data that suggested prolonged high interest rates. A series of speeches by Fed officials throughout the week, including Atlanta Fed President Raphael Bostic, Governors Lisa Cook and Christopher Waller, and Vice Chair Philip Jeffersons may offer further clarity on monetary policy. Meanwhile, Walmart surged over 5% after exceeding expectations in fourth quarter sales and earnings, prompting the retailer to raise its annual dividend and announce plans to acquire smart TV market Vizio for $2.3 billion. In contrast, Home Depot stumbled 1% as fourth quarter comparable sales dipped, reflecting consumers' focus on smaller budget-friendly projects amid economic uncertainties. Additionally, Capital One's announcement of a $35.3 billion acquisition of Discover Financial Services propelled the latter's shares by over 14%. However, regulatory hurdles loom over the deal's completion, with analysts citing potential challenges due to the consolidation of the credit card market and the creation of a significant banking entity. Yeah, my wife mentioned that yesterday, that Discover and Capital One were in the process of that buyout, and a little shocking. I mean, Discover's been around, the 80s maybe, early 90s, somewhere in that ballpark-ish, and they always have marketed themselves as a step above as far as customer service and perks and benefits, and so it is a little surprising that they would get bought out, but maybe they're in financial trouble, so who knows. All right, next up, got an article here from Zero Hedge. U.S. leading indicators disappoint, equal longest losing streak since Lehman. And this was from Tyler Durden. All right, the Conference Board's leading economic indicators sustained its downward trend in January, declining by 0.4% month over month, notably worse than the anticipated negative 0.1% month over month. December's decline of 0.1 was revised down further to 0.2% decrease. This marks the 22nd consecutive month of decline, matching the longest streak since 2007-2008 financial crisis. Stock prices remain the largest positive contributor to the index at a positive 0.1, while the average work week saw the most significant negative impact at negative 0.18. Justina Zabinski-LaMonica from the Conference Board noted that while the LEI continues to signal economic headwinds, 6 out of 10 components showed positive contributions over the past 6 months, offering a slight reprieve from recessionary concerns. Despite this cautious optimism, the LEI remains down 7% year over year for the 19th consecutive month, approaching levels not seen since the 2008 financial crisis. The annual growth rate of the LEI remained deeply negative, indicating a divergence from real GDP trends. However, recent significant easing of financial conditions suggests a potential turnaround in the LEI, hinting at a possible soft landing. This raises questions about the necessity of further rate cuts, although concerns linger about a looming banking crisis expected in March. In summary, while some positive developments in LEI components offer a glimmer of hope, the overall economic outlook remains uncertain, with continued declines and year-over-year contractions signaling ongoing challenges ahead. And that was a good point about, if we truly do have that soft landing and, we're not going to go into recession, which I believe the opposite's going to happen. Like that's truly the case, why is everyone in the financial journalists or the financial journalists and the talking heads on the business channels and everyone else on Wall Street just clamoring for when are we going to lower interest rates? Well, if there's no recession and the economy is running fine at 5.5% as a Fed funds rate, why would we adjust it? If anything, we should probably continue to move it up until the economy slows down. Then we know we've kind of hit that neutral rate. But, hey, I'm just some dumbass in the mountains. All righty, one last article here comes from our buddies over at First Trust, Mr. Brian Westbury, their chief economist. This week's article is titled January Stagflation. Let's see what Brian had to say. The prevailing notion that economic expansion typically precedes inflation fails to fully account for the economic dynamics observed last year in 2023. Despite the economy's resilience, consumer price inflation saw a notable decline from its peak of 9.1% in mid-2022 to 3.4% by December of 23. While some analysts can attribute this moderation to the alleviation of supply bottlenecks stemming from the COVID-19 pandemic, this expectation falls short in capturing the full complexity of the situation. Yeah, I put little weight on the import-export business, the bottlenecks, all that stuff. I mean, yeah, it had an effect on prices. If you need remote controls for a TV and you just got to have them, because you're selling TVs and you got to have the remote controls, you'll pay more than you normally would just because you want to, sell your product. But I think most of those problems were, cleared up. God, 2021. That was what, 2-3 years ago. So I don't put a lot of weight on, the whole supply system. And, yes, there are still some issues out there with like chip production and stuff like that. But I think a lot of that's more geopolitical. It has to really do with the, going from about 15 or 16 trillion in the M2 money supply up to about 22 trillion in a couple of months, less than a year, definitely. And, Elizabeth Warren last week was running her pie hole on, not Reddit, Twitter, or X as they call it. She was saying, well, your Doritos and, it's shrinkflation and blah, blah, blah. I don't normally get into, I don't normally respond or comment on idiot politicians, but I couldn't help myself. I went to the St. Louis Fed, the Fred.com website, pulled the M2 chart, put a big circle around it, and replied back to her. I'm like, hey, moron, this is why we have all this inflation. It's not due to greedy company. Companies sell their products for the highest possible price that people will buy it for. That's how, the economy works. That's supply and demand. I would rather have this remote control more than $30. To me, the remote control is more valuable than $30. Now, if it's $100 is what, I'd rather have $100 than the remote control. So that's how the system works. All right, let's jump back in here. A more comprehensive understanding suggests that monetary policy played a pivotal role, particularly evident in the drastic fluctuations of the M2 money supply. Despite a decline in M2, very little decline, the lingering effects of the rapid injections of money during the pandemic have left the economy grappling with excess liquidity, which continues to exert pressure on inflation dynamics. Recent economic indicators further underscore the nuanced challenges facing the economy. Reports of declining retail sales and manufacturing output in January, coupled with a substantial drop in housing starts, paint a picture of potential economic weakening. However, amidst these signs of slowdown, inflation remains persistent, with prices rising by 0.3% in January, surpassing the Federal Reserve's 2% target. This persistence of inflation amidst economic softening presents a conundrum for investors and policymakers alike, particularly in the context of equity markets. The prevailing consensus suggests that corporate profit growth, already elevated relative to GDP, would need to surge by over 30% to justify the current market valuations. Or on the other hand, things would have to contract, probably not by 30%, but it would have to contract by 25% to justify that current valuation. A scenario that seems unlikely given the projected growth rates of around 10%. While the labor market appears robust on the surface, there is a risk of it lagging as an indicator of broader economic trends. I've been saying that all along. Do not trust the employment numbers; those are lagging indicators. Do not look at that as something forward-facing. Where was I? The unprecedented policy responses implemented during COVID-19 pandemic have introduced considerable noise into the economic data, making it challenging to discern underlying trends. Nevertheless, beneath the surface, the fundamental tenet proposed by economist Milton Friedman that shifts in the money supply lead to fluctuations in both recessionary pressures and inflation remains relevant. As the economic landscape continues to evolve, the interplay between various indicators will offer insights into the trajectory ahead, reaffirming the enduring significance of monetary policy in shaping economic cycles. Good stuff. I mean, this was an amazing broadcast. I mean, I'm amazed. I've outdone myself on this Tuesday. I might just take the rest of the week up. Nah, I'll be here tomorrow. I got nothing else to do. I mean, my wife's out of town in Buffalo, I think. Yeah, Buffalo in February. Great choice for a business trip. So, and then next week, I think she's going to Northern California, which is still not, it's kind of chilly there in the wintertime. So anyways, all right. Well, that's everything that I had for today. I'm going to go out and play some ball time with my main man, Jake, wherever he went. He left his one of his toys back here behind me. And so if you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. So if you need to reach me, that's the place to do it. Hope you have a wonderful evening, and I shall talk to you guys next time. Adios.